Today, I will be talking about agricultural income. Now, there is a lot of confusion which exists in the mind of people whether agricultural income is totally exempted or it is partially exempted or exempted at all in some cases. Well, today I will be discussing these aspects in details and you will be able to understand how agricultural income can be used for your tax planning purposes and how it is going to get taxed. The definition of agricultural income is given under section 2 subsection 1, of which there are three parts, A, B and C. Section 2(1)(a) talks about rent or revenue that is generated from an agricultural land. This will fall within the definitions of agricultural income. Now 2(1)(b) talks about the processing of your agricultural produce. Now this processing income also will be part of your agricultural income. 2(1)(c) talks about a building which is just adjacent to your agricultural land. Now this building, if it is used for storing purposes or even as a dwelling house, the income generated from this house property will also be part of your agricultural income. Now let me talk about the agricultural produce like tea, coffee, rubber. Will that be considered as agricultural income? Well, a certain portion of such manufacture will be considered as agriculture. In respect of tea, there is a specific Rule 8 which talks about revenue generated from tea manufacturing will be 60% taken as agricultural income and 40% is taken as non-agricultural income. In respect of manufacturing of rubber, 65% will be considered as agricultural income and the balance will be non-agricultural income. In respect of manufacture of coffee, 75% of the manufacturing income will be considered as agricultural income and the balance 25% will be considered as non-agricultural income. Now let us come to how the taxation will be considered when there is an agricultural income. You consider both the agricultural income and the non-agricultural income. You aggregate this amount and you apply the rates of taxation which is applicable to you. You arrive at a figure X. You calculate an agricultural income net plus the minimum amount which is non-taxable. That is maybe 2,50,000 or 3 lakh, whatever is the case for a particular assessment year. You add this amount to the agricultural income and then you calculate the income tax on this amount. Let this be Y. Now X minus Y is the amount of tax that you have to pay. Of course, the distinction has to be made between the old regime and the new regime where the taxation amount will vary. But the basic method of doing the taxation for agricultural income is the way I explained.